trying to drive an economy is really hard because someone has thrown a bunch of mud onto the windscreen. The rear view mirrors don't work. You can't turn your head to look back. Trying to put your head out the window to look forward is hard. It's just hard to manage an economy, particularly when it's been going quite fast. The Reserve Bank of New Zealand found that in the last 18 months. They couldn't quite see how fast the economy was going. They knew it was going too fast and they put up interest rates. And when you're the Reserve Bank, you are essentially doing something that doesn't really have an impact for another 12 to 18 months. You really are driving with a really dirty windscreen and the mirrors don't work. Unfortunately for the Reserve Bank and the economy, it jammed its foot on the brake and then kept it on the brake, even though the economy had hit the buffers well and truly last year. In the second and third quarters, there was a significant recession. But even as late as May, the Reserve Bank was still talking about putting interest rates up and had no plans to cut interest rates until 2026. Now, that didn't last long when it became clear through late last year and early this year that the economy had been in quite a bad recession. But now it's cutting and cutting hard. But is it cutting hard enough? Has it been as adept as it could have been at taking its foot off the brake and putting it on the accelerator? Because even with the official cash rate at 3.75%, the Reserve Bank's foot is well and truly still on the brake. In this week's When the Facts Change, I talk with Jarrod Kerr from Kiwibank about whether the Reserve Bank should take its foot off the brake completely and start putting its foot on the accelerator by lowering the official cash rate below 3%. It's a bit like one of those rally car drivers who have two-footed driving styles. They have one foot permanently on the brake and one foot permanently on the accelerator, and there's an awful lot of jiggling back and forth. That's hard for a Reserve Bank to do, but it does put a spotlight on what needs to happen as an economy that's pretty much in recession still and only barely coming out of it, needs a bit of help. This week on When the Facts Change, we talk about putting the foot on the brake and the accelerator for the economy. We also talk about inflation and whether Donald Trump's tariffs will make life harder for our Reserve Bank and for people who are relying on longer-term fixed rates. That's this week on When the Facts Change. Well, kia ora, and welcome to the Spin-Off Studios to Jarrod Kerr, our old or maybe young sparring partner in a discussion about economics, fun times, chewing the fat over where prices and production and all of the interesting things are going. Great to see you, Jarrod.
Oh, great. Thanks for having me back. There's so much to talk about. I hope we're doing 3 podcasts in one here.
Oh, yeah. Definitely there's a lot to catch up on and a lot to look forward to, particularly in the last week or two with the Reserve Bank coming out with its first public comments in nearly 3 months and, of course, cutting the official cash rate by 50 basis points and bringing forward its projections for another 3 cuts from towards the end of 2025, early 2026, towards basically the next 3 meetings. And that was confirmed by the governor in the press conference. What did you make of that Reserve Bank decision and their plans to cut the official cash rate from 3.75 to what they think of as neutral in the next 6 months or so?
Well, look, we've been, openly, I guess, challenging the Reserve Bank for quite some time. Now we're on the same page. Finally, not only have they cut, but they have signalled that they will cut to neutral, which, we think is around 3, so that's nice. We're all on the same page. So I think the message the Reserve Bank has given is clear. I don't think it was clear in November. I don't think it was clear much of last year or prior years. But here we are, and we're mostly on the same page. So I've got nothing really to argue about, except I would flag that I think the risks are to the downside, not to the upside for that cash rate, because there's just so much uncertainty offshore.
Just to put this all into context, as recently as May of last year, the Reserve Bank was saying we probably won't cut interest rates until 2026. And we all went, gee, that's a long time to wait, particularly when it felt like, and we couldn't put our finger on it, in May last year, the economy was in recession. And as it turns out, it was a couple of quarters of negative GDP growth, i.e. recession. And we haven't got all the numbers for the December quarter yet, but it looks like that's going to be tiny bit of growth maybe. So we're talking about 2024 being a real washout for the economy. But at that point, the Reserve Bank was, hard on the brakes. And you could argue the economy was already in the wall and they were still stomping on the brakes. So at what point does the Reserve Bank say, we're not just going to cut to neutral, we actually need a bit of stimulation here, below neutral, below 3%. You do wonder about the lags here and whether the Reserve Bank can ever get, ahead of the curve enough to be doing things at the right time rather than being sort of pro-cyclical, making things worse.
Yeah, I think with the benefit of hindsight, the Reserve Bank's actions in recent years, I think the initial reaction to COVID was fantastic. They did exactly what was needed, and then they did too much. So the initial reaction was fine, did too much, like many central banks, to be fair, and we got this, extraordinary boom and inflation problem. I then argue that they did too much the other way and tightened too much, too aggressively, put the cash rate too high for too long. We started noticing the economy turning in 2022, right? The last quarter of 2022, we noticed in our data that things were changing for the worse. 2023 was, held up a bit by migration. Things were definitely turning, and we've recorded a per capita recession in 23. Things then snowballed into 24, and we got a very large contraction last year. So, the writing was on the wall. We noticed it in 22, right, on the hard, fast data that we look at. The Reserve Bank, in recent meetings has acknowledged that the official data not that helpful, but the fast, high-frequency data, much more helpful. We could have told you that 15 years ago.
Yeah, well, the fast high-frequency data that we've seen in the last 2 or 3 weeks from the Performance of Manufacturing Index, the Performance of Services Index, some of the business confidence survey numbers, particularly the backward-looking stuff, the stuff about right now for me rather than what do I think everyone else is doing. That seems to be saying that we are in some sort of recovery now in February 2025. But has the Reserve Bank taken its foot off the brake fast enough?
I would always say, they probably could have done a little more, but I am glad that they did turn around from May to August. That was a very quick 180-degree view because they were talking about hikes in May, not just holding the cash rate high. They were talking about hikes. They couldn't have been further from what we needed. And to turn around the way they did and then deliver 50s is, in their minds, that's super fast. And so I give them some credit for that. I think a 375 cash rate is way too high for an economy that's just been through quite a savage recession in per capita terms. So, I would argue we should be at least at 3 right here, right now, neutral. And as you say, an economy in recession probably needs a bit of stimulus, not restriction.
Now, just looking at this inflation picture, because the Reserve Bank last year was seeing quite a bit of local inflation, and they were nervous about this. Yeah. And it's interesting in their monetary policy statement, they've had a really good granular look at inflation. Which bits of inflation were most sensitive to what the Reserve Bank was doing? So when you put up interest rates, it tends to be construction sector, retail spending that's most sensitive. And which areas are least sensitive? So the things that are administered, the government fees and charges, the rates, the fines for parking, the fees for getting a passport, the visa charges that have just been trebled for people coming in on a work visa, the potential for congestion charges and increased bus fares. All of these things which are decided by a politician and some bureaucrats, basically, they are definitely not responding to the Reserve Bank. And when you look at those numbers, the Reserve Bank is saying that those at least sensitive types of inflation still running at 6-7%, which is 3 times what it should be. You do wonder if the Reserve Bank is being forced in a way by administrators of prices, so governments, insurers, those people who have monopolies on certain areas, forced by those players to punish everyone else. Because the Reserve Bank often talks about a thing called a relative price shift.
Yeah.
And because they've got a blunt instrument, they really have to push down on everything. So what that means is if the government and insurers and the EQC are putting up their prices at double-digit rates, that means the Reserve Bank has to keep interest rates higher for longer than they otherwise would to press down on things like construction and retail spending, and by having a higher interest rate, keeping pressure on the export sector. So is that a potential, headwind for the Reserve Bank there, that they would love to cut them more, but there's this really sticky and awkward and not very responsive inflation coming from administrators?
Yeah, it certainly doesn't help, right? It certainly doesn't help. And I think, we need to acknowledge that we are paying or starting to pay for the decades of underinvestment in infrastructure, right? And the councils, they need to be empowered. The councils need to be helped. They're already, up to their eyeballs in debt, but geez, they've got a lot to do, right? They have got a lot to do, and I think we've got a lot to do as a country. And a lot of the costs you're talking about are the price that we are paying for preferring tax cuts or preferring other things rather than spending on roads, rail, bridges, all that good stuff that we should have been spending money on over the last, 3 decades, really.
Yeah, because this complicates the picture for the Reserve Bank. Their job is to keep consumer price inflation somewhere between 1% and 3% over the medium term. And when we think of consumer prices, we think about, what we pay at the supermarket, what we pay for an air ticket. But when we get charges coming through to us that are in effect capital charges, these are charges for buying and investing in assets. This is not something that we're going to eat. We're not going to eat a bridge when we pay a congestion charge, which is going to pay for a motorway. We're going to use the service, but we're also paying for some of the capital in there. And I wonder whether a one-off capital cost into consumer prices shock is something that our inflation targeting regime was set up for.
Well, I think it's, it certainly doesn't help these sorts of moves, but, it's not uncommon to have an asset built and a toll road put on it and, as a way of paying for it. And I think we do need to stump up and pay more to the councils. We have to if we want, the traffic congestion in Auckland to ease up, or if we want those beautiful fountains that are spouting up in Wellington to be fixed. There's a lot of money that needs to be, put into that. From an inflation targeting point of view, it does complicate things a bit. There are some one-offs in there that obviously you will look through. But as you say, some of these things are ongoing, and I expect them to be ongoing. Like, I think council rates are up 15%. They're not going down. I could see them rising another 15%. And then, on top of all of this, we're trying to combat climate change and cyclones that are ripping their way through the economy, and you're getting insurance premiums up, 24 to 28% on the last year. This has just exacerbated the cost of living crisis Kiwis are paying.
It's interesting to see these cost pressures coming through and looking at how it's, keeping interest rates higher than they otherwise would be. And also there's a slight frustration building, I think, for a lot of those people who were on fixed mortgage rates, and they've seen the official cash rate drop a couple of 100 basis points. And to be fair, a lot of the discounted fixed rates, you can now get a 4.99% rate around the traps. That looks pretty good. And then they think, gee, is it going to fall another 100 basis points? And it was interesting at the Reserve Bank press conference, Karen Silk, the assistant governor, was asked, how much further could these longer-term fixed rates, the 2 years, the 3 years, fall? And she pointed out rightly that, the Reserve Bank can control the short stuff, the 90-day bills, the floating mortgage rates, less control over the longer-term stuff, and that's where global bond yields are more of an issue. Could we be frustrated in our hopes for much lower mortgage rates by what's happening overseas?
Well, first of all, as they cut the cash rate, we're going to see the floating rate, the 6-month rate, and the 1-year rate fall. And I'd argue we'll still see that 2% rate that you talked about fall further with another 75 basis points. The 3-year, 4-year, 5-year, we don't get a lot of interest out there, to be fair. But what are those rates likely to do? Well, tell me what US Treasury yields are going to do, and I'll tell you what those rates are going to do. What they have done is they have risen as Trump was coming into power. Trump is seen as very pro-growth, pro-business, pro-inflation, or will cause inflation, which caused US yields to lift and the longer end of our curve to lift or hold higher. The shape of our curve is actually really steep at the moment. So you've got the Reserve Bank cutting those shorter dated rates lower and those longer end rates are holding higher. Our curve is actually quite steep in comparison to others and actually looks attractive to international investors, which is another story altogether. But yeah, 1 year rates, 2 year rates, I think further to fall. 3-year rates, 4-year rates, tell me what's happening offshore.
Just speaking about what's happening offshore and this idea that Trump is a pro-inflationary president. He's got all these tariffs he's going to push through.
Yeah.
He's going to be running big deficits. He's going to be issuing lots of bonds. There's going to be tax cuts for rich people. There's going to be plenty of action in the American economy. At least that's what he'd like to see. But is that really true? Because, if you look at tariffs, depending on where you are in the world and what you're selling, it's not obviously inflationary. And it's interesting, just in the last week or so, we've seen these longer-term bond yields fall because people are beginning to wonder, maybe all the chaos in and around Trump is starting to unnerve consumers and maybe we won't get the inflation. What do you say when someone says, Trump means inflation? Or does it?
Not necessarily. I think if you're talking about a United States citizen sitting in the United States, yes, inflationary, right? That's quite clear. But a New Zealand citizen sitting in God's country, it's not so clear. It depends how they treat us, for starters, and how they treat our other trading partners. So do they put hefty tariffs on China, for example? Well, you will see companies actually getting around it by shipping from China to New Zealand to the United States and getting around such a tariff if that's possible. Or you might find that a lot of goods that were made in China, destined for the United States, actually wash up on our shores at a 30% discount. EVs, I think, is a classic example with Elon having fun over there. So it's not necessarily inflationary. It might be deflationary for certain goods, inflationary for others. We just need to find out how he's delivering them. The other thing I would say is there's some good research out there by our own Treasury that says, look, a 10% tariff is a revenue grab, right? You put 10% tariff on, Treasury numbers will tell you that your revenue goes like that. You put 25%, 40% tariffs on, you don't actually collect a lot of revenue from that tariff. Why? People divert, they substitute. So it'd be really interesting if he does actually put on these 25% plus tariffs that would force a change in behaviour, or whether it's just a negotiating tactic, right? They say take Trump seriously, as in tariffs are coming, but don't take him literally, as in he'll tell you he's putting on a 50% tariff, negotiate something with you, and you find out that you've got 10% tariff.
Yeah, because the differences in tariffs between countries will really make a difference for us. It sort of snuck up on people that the United States is now our second largest trading partner, ahead of Australia. And one of the reasons for that is our strong sales of beef into the American market. We sell the lean stuff that gets ground up and mixed with the fatty stuff and goes into burgers. And a lot of our wine, again, higher priced stuff, the Sauvignon Blancs and the Chardonnays and all of that go into the United States. And in theory, because Canada exports a lot of beef into the United States, there's a lot of wine that goes from Mexico or sometimes through Mexico, and a lot of food as well, that New Zealand as a food exporter into the United States might do quite well if we don't get tariffed like the Canadians.
Kind of hope we're small enough not to make it onto the radar. Yes, we do have a trade surplus with the US, which in theory puts us on their radar. Hopefully we don't get those sorts of tariffs, and it could be quite beneficial for New Zealand. You're right. Something to watch. But what worries me in what you just said is our second largest trading partner, our first largest trading partner, who's going at it at the moment, right? How does that play out with us? That global disruption to supply chains, that global potential for trade wars. As a small open exporter, we've got to be wary.
And we saw the tiniest hint of that this week when just one Chinese ship, a couple of 100 miles off the coast of Australia, decided to start telling everyone on its radio system that it was going to fire some shots into the sea harmlessly, and a whole bunch of planes had to be diverted because there'd been no notice.
Can't underestimate that. That one ship outweighs our entire navy. We're already outnumbered.
Yeah, it's that's going to be one of the issues. Actually, is that defence spending all around the world is going to have to go up. And if you look at the pressures on the budgets of not just our government but every government, and ours, we start from a low base, unfortunately.
Yeah, and a lot of that is actually the United States saying it's time for the rest of you to step up and look after yourselves. New Zealand is definitely underinvested in our defences.
Now, just to wrap up on the picture going forward, we've had these rate cuts. Everyone seems to suggest that there will be some sort of recovery, particularly towards the end of 2025. Where's that going to come from? Because interestingly, the Reserve Bank again downgraded its business investment forecasts, and the government would like to see lots of foreign investment, but that's still uncertain. So where is the growth going to come from?
Mary Jo, who I work with, put it really nicely the other day. She said, look, we just have to trust the process. And she's right. We just have to trust the process, right? Rates are being cut. That'll feed through. It'll feed through to businesses with debt, particularly small businesses who have debt with a house linked to it if the housing market rebounds. So that's their confidence up. But what will really get business confidence up? Activity, consumer spending again. Okay, so interest rates are falling and that should help. Trust the process. So we are, and we're looking at the lags and we're saying this is great that most Kiwis have fixed for a year or less, a lot of them on the 6-month rates. So they've taken a punt, the punt's paid off. So it's going to feed through faster than other cycles. And we're kind of just literally doing the math. And if you start cutting in August and you really start delivering, some hefty cuts, it's feeding through over the next 6 months plus. So we're all just trusting the process and putting in, a recovery in consumer business spending in the second half of the year. It's really, don't tell anyone, it's that simple, but it really is that.
You mentioned that the yield curve. Whenever I think of a yield curve, I think of a slope that's going upwards, and I always think things roll down slopes. Yeah. And in a way, that's what we're going to see is 100 billion plus of mortgages roll down the slope. roll on to a cheaper rate and probably a shorter rate, because that will be the cheapest of rates.
So what are households going to do? What's their marginal propensity to consume, if you really want to bore your listeners? Well, what are we thinking? We're actually thinking right here, right now, they've been hurt. They probably want to rebuild a bit of equity. They want to rebuild a bit of savings. So I think, from what we're hearing from our customers, is they're trying to maintain higher repayments on their mortgage, which is great. That's great. You're paying it down faster. But I think as the year goes on, I think we'll start seeing people willing to spend more and save less, which is exactly what we kind of need. We need that spending to pick up throughout the economy.
So 2024 was all about surviving until 2025. Is 2026 going to be the year in which we fix in 2026?
Yeah. And we're saying thrive in 25 and then fix in 26. We're getting clever here. We certainly hope so. Yeah, we certainly hope so. But based on our forecast, trusting the process, pick up in the second half of this year, activity picking up in the second half of this year, and then next year businesses going from a very, closed-minded, putting out fires type mindset to a growth mindset, and looking to invest again, looking to hire again. That's the story for next year.
Jarrod Kerr, Chief Economist at Kiwibank. Fantastic to have you in here to chew the fat on the economy, the world and everything. Thank you very much. Ngā mihi nui, where you've been listening to When the Facts Change on the Spin-Off Podcast Network.
Great, Bernard. Thanks for having me.